So, what's the biggest myth crypto taxpayers believe about anonymity? Like they're anonymous. And how does that usually backfire? So, if somebody moved crypto between wallets or to offshore exchanges, does that reduce visibility or does it actually increase your scrutiny at the IRS? So, if somebody says, I didn't get a 1099, so I didn't report it, how
No.
does the IRS respond to that? When you have crypto, is reporting some of it, some of the crypto income better than reporting none? Or does partial reporting sometimes make things worse? You kind of mentioned this earlier. But what if the crypto tax software that a client of mine or a taxpayer is missing data?
Okay.
How does the IRS use or treat that excuse? So what's the one thing a taxpayer does during a crypto audit that almost always guarantees deeper scrutiny? So what's the biggest myth crypto taxpayers believe about anonymity? Like they're anonymous. And how does that usually backfire?
It's not anonymous at all. I mean, blockchains or cryptocurrency environment is built on distributed ledger technology. And what that really means is that transactions may be pseudo-anonymous, but at the same time, they're all publicly known because it is on the blockchain. There are blockchain explorers that anyone can use. They're free. Anyone can learn how to use them to basically trace transactions. And all transactions are on the blockchain, and they're
Okay.
for everybody out there to find. And the IRS actually uses a number of proprietary tools to kind of look at the blockchain because it's not an easy task to look at that stuff. But yeah, all of that is on the blockchain, and eventually that will lead to an exchange. And if it leads to an exchange, a specific name can be identified because the
Oh,
IRS can go to the exchange and, well, tell me who this transaction is associated with. That's on your book. And that's how they find taxpayers.
wow. So if somebody moved crypto between wallets or to offshore exchanges, does that reduce visibility or does it actually increase your scrutiny at the IRS?
It reduces the IRS availability of those records because
Okay.
sometimes they have to file an exchange of information request with the foreign tax authorities, and those foreign tax authorities go to the offshore exchange and ask them for records. The IRS record of getting those documents is pretty spotty because
Okay.
the IRS can themselves go to those exchanges typically. Some of them they can, but
Okay.
most of them they cannot.
Out
So
of their
they will have to go
jurisdiction,
through
right?
foreign. Yeah, it's a jurisdictional matter. So yeah. But whenever the IRS sees foreign records there, yeah, that kind of increases the level of scrutiny there because it's I mean, sometimes it is an of effort by the taxpayer to hide assets, sometimes it's not, but yeah, it is a factor, definitely.
So if somebody says, I didn't get a 1099, so I didn't report it, how does
No.
the IRS respond to that?
Well, you don't need a 1099 for an income to be taxable. I mean, it's all under Section 61 of the code. All income is taxable unless you can show that it's not.
It
So
doesn't say
it's
worldwide income, and I think that's where we
yeah,
define gross income. What is that, line
yeah,
8 on the
gross
1040?
income.
Yeah,
Yeah,
yeah, yeah, yeah.
basically.
Lines, yeah,
Yeah.
code section 61.
Yeah,
Sure.
so funny you mentioned 1099s because starting this year, this coming filing season, there will be a Form 1099-DA. And
Okay.
that Form 1099-DA will have to be filed by U.S. exchanges and will specifically address cryptocurrency transactions. So starting this year, yeah, they will have to report proceeds. But starting next year, starting in 2027 for 2026 tax year, they will have to be reporting basis. But based on what I can see, that information is never going to be accurate.
Something similar happened in the Securities and Exchange
Yeah.
when the broker dealers were required to report, like the big names that people see on TV, were required to report basis for taxpayers for their stock transactions.
Right.
Now they're pushing crypto into that same sphere, is what you're saying, that it's going to be
They
regulated
are.
just like the SEC regulates
Yeah,
the
it will be regulated. Well, as a matter of fact, I recall seeing back in tax year 2016 or 2017, I recall seeing 1099s of various types filed by exchanges. Coinbase filed 1099K. There were also 1099B filed. Then they stopped. Some exchanges filed, some exchanges didn't. But IRS used that as a proverbial foot in the door, because at
Okay.
that point, they knew that the taxpayer was involved in crypto. So
Uh-huh.
even if, like, let's say 2023 was under audit, they would go back to 2017 and say, well, I see you were involved in crypto in 2017. Did you close that account? What happened to it? Why
So
didn't you report it? What
what
were
you're talking about is when crypto activity from years ago, this is when it's suddenly getting them into trouble now. And that's why. But why now? I mean, are they seeing things now and then going back, or how does that work?
Oh, absolutely. Yeah. I mean, they still have data from the original John Doe summons in 2016, 2017. There were about, I don't know, 15 John Doe summons actions filed,
Okay.
against various exchanges. It started with Coinbase, then there was Poloniex, Circle, there was Gemini, Kraken, all the bigger ones. And by the time the John Doe summons action concludes, those years are typically out of statute. So they
Oh,
use those old records to kind of go into the future. They use those records to look at present activity, and it's the revenue agent's job to basically develop the case based on the old records. They have
okay.
access to 2016, 2017 records. They analyze those records, look for any additional leads, and then they go back to those exchanges and issue a summons for current records.
Okay.
That's
Okay.
how they get that.
So is crypto, when you have crypto, is reporting some of it, some of the crypto income better than reporting none? Or does partial reporting sometimes make things worse? You kind of mentioned this earlier.
Yeah, yeah. Well, it's always better to report some of it. I mean, I guess from a taxpayer point of view, they may not always have access to records from certain exchanges. It's because I've seen it. Some exchanges are here one day, but not next day. We've seen what happened with FTX.
Yep.
Uh,
Yep.
it was here, then went under, and when I was with the IRS, handled some of those cases, and people were not able to get records, and they were kind of in a pickle because everybody knew and they knew they were supposed to report it. No way to access those records, and they were in a pretty unfortunate position.
So when we met in Las Vegas for that American Bar Association event, you mentioned the software tool that you preferred. They used several tools at the IRS, but some people, some taxpayers rely on crypto tax software. And the one you used, I don't think it was ever missing data, but what if the crypto tax software that a client of mine or a taxpayer is missing
Hmm.
data?
Okay.
How does the IRS use or treat that excuse?
Yeah, well, there are several different types of software programs available to taxpayers that they can use to compile their data and produce an 8949. Some
My
of them are
preference is Coin Ledger.
CoinLedger. Yeah, CoinLedger is one of the good ones. I
Okay.
like using that. It is a good tool, and sometimes IRS accepts the findings from that program. Sometimes it doesn't. But it's definitely better. It's definitely better to have something to have a calculation for the IRS that they can start with.
Okay. So what's the one thing a taxpayer does during a crypto audit that almost always guarantees deeper scrutiny?
One thing that a taxpayer does one thing that a taxpayer may do to warrant a scrutiny would be not reporting any crypto transactions when you had crypto activity going back years, especially. That's what basically that's what gets people crushed. It's basically under reporting gains because, folks may think that, I didn't cash out my crypto, so there should be no tax on it. But as a matter of fact, swaps and staking rewards are taxable events.
Yeah. Yeah.
Just because it happens within the exchange platform, that's where taxable transactions take place, not upon withdrawal. The
Right
taxable
on.
transactions take place within the cryptocurrency exchange platform. That's one thing. Then, of course, incomplete records, it will kill you too. If if you cannot reconstruct your transactions history with tools like blockchain explorers, it's not really good.